Billions of dollars in dreams turned to dust almost overnight. The Dubai debt crisis exposed staggering financial vulnerability in what seemed an unshakable oasis, built on sand and ambition. This desert metropolis once flourished with unprecedented speed, drawing investment from across the globe, promising endless prosperity and economic might. Its audacious vision involved world-class architecture, like the world's tallest structure, soaring over 150 stories high, and artificial islands shaped like palm trees, adding hundreds of miles to its coastline for residential and tourism. Property prices skyrocketed, seeing gains of 50% annually for several consecutive years, attracting millions of expatriates seeking new opportunities. Developers borrowed billions upon billions of dollars from international lenders, fueling this extraordinary boom with massive loans totaling nearly $120 billion by the late 2000s. Then the global financial crisis struck in 2008, sending shockwaves through every corner of the world economy. Dubai's highly leveraged real estate market was particularly vulnerable to this sudden downturn. Property values plummeted, losing more than 50% of their peak worth within just 12 months. Major development companies like Dubai World faced critical liquidity shortages, unable to meet payment obligations on tens of billions of dollars in debt. Speculators fled the market, leaving behind half-finished towers and empty luxury villas. Confidence evaporated as thousands of construction workers lost jobs and thousands more residents departed the emirate. The prospect of sovereign default loomed large, threatening to destabilize the global financial system further. At its lowest point, Dubai World announced a standstill agreement on $600 billion of its debt, causing widespread panic in financial markets. This unprecedented move highlighted the true scale of the financial hole. Neighboring Abu Dhabi stepped in with crucial financial assistance, providing $20 billion in emergency funding to prevent a complete collapse and restore market trust. This lifeline allowed Dubai to restructure its enormous debt obligations, which amounted to approximately $109 billion by 2010. New repayment schedules were negotiated with creditors, extending deadlines and reducing immediate pressures. The crisis served as a harsh lesson on dangers of unchecked growth and excessive borrowing without sufficient regulatory oversight. Years after the dust settled, Dubai embarked on a more measured recovery, focusing on diversification beyond just real estate and tourism. The government implemented stricter lending rules and enhanced financial transparency. Billions of dollars continued to flow into infrastructure projects, but with greater emphasis on sustainability and long-term economic stability. The population, which had dipped slightly, began to grow again, reaching over 3 million residents. Its economy showed resilience, expanding by an average of 3 to 5% annually in the following decade. The crisis, while painful, ultimately reshaped Dubai into a more cautious and robust financial center, proving even an oasis can face a drought. But with strategic support and adaptation, it can regrow even stronger. More than $109 billion in debt threatened to sink an entire nation. The Dubai debt crisis truly revealed how deeply interconnected global finance had become and the sheer scale of the speculative real estate market built up. Major developers, spearheaded by government-related entities like Dubai World and its subsidiary Nakheel, borrowed tens of billions from international banks. This massive capital influx fueled extravagant projects such as the iconic Palm Jumeirah and the ambitious World Islands, increasing Dubai's coastline by hundreds of miles. Property prices had been escalating by up to 50% annually for several consecutive years, drawing millions of expatriate investors seeking quick profits. Investment poured in from all corners of the globe, eager to partake in the rapid expansion of this desert metropolis. The lending spree saw total debt balloon to an estimated $120 billion by late 2008. When the global financial crisis hit in 2008, the highly leveraged market faced an immediate severe liquidity crunch. Property values plummeted, losing more than 50% of their peak worth within just 12 months. Thousands of construction workers faced unemployment, and many thousands of residents departed the emirate, creating ghost towns of half-finished skyscrapers and empty luxury villas. Dubai World, a key player, announced a standstill agreement on what was widely understood to be $600 billion of its project commitments, triggering widespread panic among 90 international lenders and bondholders. Fears of a sovereign default spread globally, impacting financial markets far beyond the Middle East. Neighboring Abu Dhabi provided a critical $20 billion emergency funding package, preventing a complete economic meltdown, allowing Dubai to begin the painful process of restructuring its formidable $109 billion debt pile. Negotiations commenced with creditors to extend repayment periods, typically by 5 to 8 years, and adjust interest rates. The crisis forced a radical re-evaluation of development strategies, shifting emphasis from pure scale to sustainability responsible growth. Stricter financial regulations were implemented, and transparency became a key governmental priority. The population, which dipped during the crisis, began to recover steadily, eventually surpassing 3 million residents. The economy, despite the severe setback, demonstrated remarkable resilience, growing by an average of 3 to 5% annually in the subsequent decade, proving that strategic adaptation could lead to stronger foundations, even after facing such immense financial sands of debt. A desert metropolis nearly crumbled under its own ambition. The Dubai debt crisis hit hard, revealing deep global financial links and the vast scale of speculative real estate built up over years. More than $109 billion in debt threatened to sink an entire nation, a staggering sum, showing how connected everything was. Major developers, mainly government entities, like Dubai World and its subsidiary Nakheel, had borrowed tens of billions from 90 international banks. This massive money flow fueled extravagant projects like the iconic Palm Jumeirah and the ambitious World Islands, adding hundreds of miles to Dubai's coastline. Property values had been soaring by up to 50% annually for several consecutive years, luring millions of expatriate investors seeking quick profits. Money poured in from all corners of the globe, eager to be part of this rapid expansion. The total debt blew up to an estimated $120 billion by late 2008. When the global financial crisis struck in 2008, the highly leveraged market faced a sudden severe liquidity crunch. Property values crashed, losing more than 50% of their peak worth within just 12 months. Thousands of construction workers lost their jobs, and many thousands of residents left the emirate, creating ghost towns of unfinished skyscrapers and empty luxury homes. Dubai World, a key player, announced a standstill agreement on $600 billion of its project commitments, triggering widespread panic among 90 international lenders and bondholders. Fears of a sovereign default spread globally, impacting financial markets far beyond the Middle East. Neighboring Abu Dhabi provided a critical $20 billion emergency funding package, preventing a complete economic meltdown, allowing Dubai to begin the painful process of restructuring its formidable $109 billion debt pile. Negotiations commenced with creditors to extend repayment periods, typically by 5 to 8 years, and adjust interest rates. The crisis forced a radical re-evaluation of development strategies, shifting emphasis from pure scale to sustainability responsible growth. Stricter financial regulations were implemented, and transparency became a key governmental priority. The population, which dipped during the crisis, began to recover steadily, eventually surpassing 3 million residents. The economy, despite the severe setback, demonstrated remarkable resilience, growing by an average of 3 to 5% annually in the subsequent decade, proving that strategic adaptation could lead to stronger foundations even after facing such immense financial sands of debt.